All right, everyone. Thanks for coming back to another episode of Non-Del Innovators. Again, I have a great guest today. I'm Matt Coles, National Sales Manager with First Funding. Today, I have Jen McGuinness with Pivot Financial. Say hi, Jen.
Hi, Jen. Hi, Matt. How are you?
I'm good. Jen, your resume is impressive. I only have one thing to ask to you, which is where do you keep your 2023 Housing Wire Woman of Influence trophy? Where is that in your house?
You know what? It's more of like an announcement ribbon, but for your humor, I was recently at the Housing Wire Annual, and I happen to have
Oh, look
my
at you.
glass right here, and
Yeah.
you'll see that if you win Housing Wire stuff, right?
Oh,
Like you'll see I have a Vanguard Award there and a Women of
yeah.
Influence that when you go to the Housing Wire conference, they actually put ribbons on your attendee badge. But
It's
it was
like
actually funny that I happen to have that laying there. Good question.
it's like grown up Boy Scouts. It's amazing.
In some ways, yeah.
Yeah, it's
Yeah.
like
I
your
mean,
your
I'll have to
merit
get like,
badge.
I mean, in some way, yeah, I'm gonna have to get my Daisy Girl Scout vest back out and start putting this stuff on it. But yeah, no, that's kind of cool when you go to the conferences though.
Yeah,
Thanks
no,
for
that's
asking.
definitely, I'm sure it was a well honed or well deserved honor. In fact, so I've met you recently since the beginning of the year, right? When I joined First Funding. And quite honestly, when you and Nate sit down to talk, I just listen intently because you guys are two of the smartest people that I've ever heard at a table before. So I appreciate everything that you've done in the industry. Was there a turning point in your career where you're like, oh, this isn't just a job. I'm going to make this my career. Was there something, a special leader or a special organization that made you join, go to that decision?
I wouldn't say that it was a specific organization or a specific leader, but I will tell you it was kind of like a happy accident. So, little known fact at large to the public is that I was originally a classically trained opera singer. And after
Wow.
deciding to leave music conservatory, I was actually going to become an M&A lawyer. I actually got a paralegal certificate first to get ready for law school, but then ended up managing a national footprint for a law firm for foreclosures, bankruptcies, REOs, evictions, yada, yada, yada. You get the point, right? Well, I got into law school 3 times. I never went, but I got poached by a client. And that's actually how I started more on the secondary capital market structured side. And then away we went for the last, 25 plus years.
It's amazing. I don't think it's when you talk to a lot of people, no one ever says they want to set out to be in the mortgage side of the business, but yet here we all are, right? I'm sure there's a lot of stories like that. So tell me a little bit about Pivot Financial, what you guys are up to, and a little bit about the organization and what you guys are focused on.
Yep, so Pivot has 2 silos to our business. As you know, we have the correspondent aggregator, where we enter into contractual relationships with lenders to originate loans to our specifications, both delegated and non-delegated channel. We also have the due diligence company. We have a robust, breach defense group for, rep and warranty related claims. We also handle litigation support there, and we are an asset manager. So we oversee our own portfolio of loans as well as portfolios of others, loss mitigation oversight, scratch and dent correction, those types of things as well. When I set out to build this business, it really was to build a platform that was not just a trade and it was a business. And if the market changed, it could proactively react to the markets. And, knock on wood, we've done just that over the course of, since 2018 till now, even though the business has gone through a couple iterations, I've been at the head the entire time.
Yeah, you got to in this industry, right? You got to be nimble and ready to adapt at any given moment. That's absolutely part of this for sure. So one of the things, with this non-Del influencer podcast that we're trying to accomplish, right, is the idea of some people that want to move into that non-Del space, maybe for the first time, or maybe it's been a while since they've been doing it, or quite honestly, what we're actually seeing is some of the full delegated people coming back to the non-delegated space just for cost savings. So one of the things that you and I have talked about quite often is the role of non-QM in the non-Del space. And I kind of wanted to get your feedback about where you think that plays, because what I hear quite a bit when we go out with our sales team is, I'm going to just do my conventional 680 plus credit score on this program or on the non-Del warehouse line. I'm not sure I want to be able to put non-QM on there. I'm not super comfortable with that process. Can you just give us some feedback about why the non-Del space might be good for non-QM lending?
Yeah, look, I think non-del is a good option for lenders overall, specifically as it pertains to non-QM. I think a lot of guys feel like it's safer, in quotes, for them to go non-delegated because when there's somebody else who's usually your aggregator underwriting side by side to you, generally they feel more confident that their underwrite was done well. In addition, let's not lie to ourselves, the large majority of people's origination for the last decade has been agency only. And then as, non-del with, more 12, 24-month bank statement, 1099, 1-year tax return, et cetera, has made a comeback. The companies have had to metamorphosize to also have manual underwriters, right? Because they're not all AUS, or they're AUS with an overlay, which is still a manual underwrite. So I think that people are being cautious, not only about do we manually underwrite these loans well and correctly, but I also think even some of the largest lenders are just afraid to make the reps and warrants for non-QM loans. I think mistakenly, a lot of people attribute non-QM to the subprime of, pre-2006 era, and that's not what non-QM is today. So I agree that when the aggregator or a third party for the aggregator underwrites before you submit the loan to them and conditions it for you, that you should have a better, cleaner loan for delivery and candidly get your loan purchased faster. So I think that's important. So there's still a rep and warrant component to that, but I think that's the comfort that the lenders are really getting. At Pivot, we actually let you go delegated or non-delegated by product.
Right.
Because if you're really confident in, certain underwrites versus others, it allows you to get your feet wet and understand the products. And I think that that's an important differentiator as well for lenders today.
Well, I think, I've been doing this for 20 plus years, and I think what ends up happening, right, when non-QM rolled out, I'm sure you remember, it was 24-month bank statement. That was the program, right, essentially. Now we're starting to see lighter and lighter and lighter documents. What's your feedback on some of this light doc non-QM that you're starting to see?
I think it depends on which version, right? Like I'll jokingly say, if we go back to the Nina, Pinta, and Santa Maria loans of yesteryear, people deserve what they get, right? And what they manufacture. But, we haven't, except for one guy, hasn't really done that yet, right? I think the large majority of what you're seeing lighten is asset statement time periods. You're seeing a non-QM, certain aggregators going from what is more the market standard 60-day asset statements down to 30-day. You're seeing a lot of alternative valuation allowances, be it BPOs or AVMs or automated valuations of different types. And I think, I think those expansions, look, if you want to use an automated valuation model and do a 60 LTV, I'll let you do it all day long, right? But if you want to do an 80, 90, 95 LTV, on an automated valuation model, when I can run 4 of them and have a $400,000 swing on the same property, that's where I think it starts to get dicey.
I think that's where
that's what people need to think about.
That's where I think I see, that's where I get a little bit nervous. Listen, you're talking to a guy who I cut my teeth at Greenpoint, right? So I know what a 78-page no doc rate sheet looks like, and I remember selling those programs. And, when you get to the higher LTVs and it gets a little bit choppy and or dicey when you start seeing the higher LTVs and the lower credit scores. Those are the things I'm like, hey guys, are we making sure that we're not just underwriting to make more people qualify, but we're actually underwriting to a good quality borrower?
Right, I know, but I think you also have to think about, during what people call it the housing crisis, the Great Recession, whatever name it is you put on that. At the end of the day, what did the investor have to rely on? They needed to rely on the value of that home or multi-unit property. And at the end of the day, if you have to liquidate the thing, you have to repossess the property via foreclosure, liquidate via REO, or it goes third party. What's going to pay you off or not is the value right?
Right.
Don't get me wrong. I'm not bastardizing credit underwriting in any way, but the value is extremely important.
Yeah, and I think that if you really go into it, right, like would you rather do a 75% bank statement loan with a 740 plus credit score, or a 100% 580 credit score for, maybe an FHA cash out at 80%, right? There's just a level of risk that you're willing to take, right?
Right, but I think, there's also a misnomer in the market, and the market misnomer is that agency loans are safer than non-QM. Well, I'll give you a personal story, okay? When I bought my house that I currently live in, I don't know, 2-3 years ago, right? I did an agency loan. I got a DU eligible accept, straight up, right? They never asked me for my tax returns, okay?
Right.
It's a requirement for an agency underwrite, right? Went all the way through the underwriting, went to closing. I was literally handed a piece of paper at the closing that says, I provided my tax returns, and those tax returns were reviewed to make the decision on my loan. No, they weren't. So I actually raised my hand and said to the closer, I said, nobody asked me for my tax returns, okay? So I can't sign this document. They literally told me to put an X through it and go to the next document. I don't know how that's safer. At the end of the day, I know how DU approved me, however, right? And LPA, right? Because I had a lot of assets,
Right.
Okay? But that's an asset underwrite. That's not an agency underwrite. So is
Correct.
that technically correct? Versus 24 months of bank statements to actual cash flows in my bank account, taking out the stuff that doesn't make sense and makes noise, and equalizing what my actual cash flow is. If you ask me, the 24-month bank statement is less risky in that example.
Right. So let's talk a little bit about that. So this deemed perception that I don't want to do non-QM on the warehouse facility because it's more risky other than conventional. But one of the great conversations that you and I have had in the past is what happens when a file does go sideways, right? Like what is the repurchase request look like, and how does a non-Del or even a correspondent lender go about defending themselves in that situation?
So I think, no matter what the headlines are, the data that's coming out where it says that repurchase claims are going down, it's not true. As I told you earlier, we have a breach defense division, and candidly, we've never been busier, right? So, and it's not just the agency repurchase demands, it's also non-agency repurchase demands or agency repurchase demands from aggregators that aggregate from other lenders and then deliver. Makes sense? So, we're really busy. When a loan goes sideways, so I think there's twofold. There's the actual breach of rep and warrant, and then there's the aggregator doesn't buy the loan question, right? So since you guys are a warehouse lender, I think it'd be good to, touch upon both, if that's okay.
Yeah, please.
So in the loan's now on an extended dwell because the investor that, you lock the loan with isn't honoring your lock, whether it's based on a defect with the loan or if they're just not going to buy the loan, there's a lot that you actually can do. Post-origination cleanup for a gap to be able to fix a condition and then relock it elsewhere or deliver it on the market. We actually do that a lot on our asset management division side. So I think, if a lender has an issue, we probably can help them with that. In the real rep and warrant review, loan was originated, sold to an aggregator, went to a GSE, or you direct deliver to a GSE, or a non-QM assets going to an aggregator, whatnot. They've got to put that back to you. But in order for a loan to actually be reviewed and responded to for a breach, they actually have to tell you what the breach is.
Right.
I think that's really important. In addition, they should be documenting that they've proven that the breach exists, not just talk about it. Okay.
Right.
So we spend a lot of time with our clients reading what I would call pie in the sky allegations that nobody's proven or provided any documentation to support. I'll give you an example. We get a lot of, we do not believe that the appraised value was correct.
Right.
Okay,
I'm glad. Yeah, I'm glad you're tackling this one, because this is a known issue for a lot of people at this point, right? Like, and what you said to me in the past is the letter basically comes out and says, we don't agree with your value. Well, I followed all the air policies. I did everything I was supposed to do. So take it from there. What's the response that you typically see, and what do you suggest people do?
Yeah, I mean, look, there are certain things that, are reasonable market levels, with regard to, for example, line item adjustments and whatnot. Like if all of a sudden your appraisal's got 56% line item adjustments, your comps are terrible and your valuation isn't supported, right? Like, so there's the blatant stuff that makes no sense, right? Then there's the semi-nonsense that we continue to see, which is, well, the comparables that you used, were a little bit further than other available units in the subject's neighborhood. Okay, well, my unit's a new construction, right? 2024 new build. The available comparables in the neighborhood were built in 2006, 13, and 1999, respectively. I went 3/4 of a mile further to give you a 2024 new build just like mine. Okay. However, when you get that claim, they're literally going to say, these are the other 3 comparables we think you should have used, which were the 3 I just quoted. Most of the time, those comps are not going to be in the same repair, condition, amenity level as your new construction, as an example.
Right. Okay.
Another great one is if you have a house that's more of a 1990s, say 2010 build, right? And they say that you should have comped that to a house that was the same age but not upgraded. Well, what if the subject property has been upgraded? New kitchen, new bathrooms, hardwood floors, yada, yada, yada. They like to send back breach claims for things like the age of the houses that you used were not aligned to the subject itself. I don't really care if the house was 32 years old, if the entire thing's been gut renovated. You need to be able to compare that to the finish out in a proper structure, right? So we spend a lot of time on that. We have some clients that really use us for all of their appraisal defense, you know what I mean? And things like that because of how we look at it. I also think it's really hard for a lender, and I literally put this on LinkedIn. It was like a tip of the week that I put up there. Do not, on an appraisal issue, go back to your appraiser and ask him more questions and change your origination appraisal. By virtue of you doing that, you're actually saying, maybe I didn't do something at origination I should have done. Remember that they're asking you to buy the loan back, right? Based on the fact that they believe the appraisal at origination was not the right appraisal to be used. All that does is actually make this harder for you. So don't touch the appraisal. Do not go back to the appraiser. Do not do anything with it except answer and refute based on what is in your origination document. Okay. So I think that's extremely important.
I'm smiling because it reminds me of an argument with my wife. When I say, she argues with me and I go, well, I did this, this, and this. And she goes like, I didn't tell you to do any of that. I told you to do this. So you want to make sure that you just have it all protected and wound up. Tell me a little bit about Pivot Financial and the next 6 months. One of the things that we talked about before we got onto this phone call, actually, before we get to that, is systems and processes in place, right? First Funding, has minimal employee count. Pivot Financial has minimal employee count, but here we are putting up massive production numbers, right? Talk to me a little bit about how important process is for you over headcount.
So I think it's process and experience, right? So if you looked at our core team, right, we don't have any, we don't have executive or mid-level management with like 2 years of experience, right? We have 44 years of experience, 30 years of experience, 25 plus years of experience, et cetera. I also think it's important, and your team's a good example. Nate, Jim, Janine, you, et cetera. You guys actually know how to do the jobs for what your business does, whether you're the president of the company, the executive chairman, the head of sales, you get my point, right? To your point, you were selling, no doc loans back in the day for Greenpoint, right? So I think that's very important and differentiating. The other thing is, don't throw people at a problem, throw a process, a procedure, and a system at an issue, right? It's like a manufacturing line, right? So you want to have that structure. And if you don't make your team adhere to a structure and you hire 10 more bodies to offset the fact that you don't make your team adhere to a structure, that's a net negative that, quite frankly, is going to put you in the red quickly. Why are we successful? We have systems. we have process, we have expertise, but our business is dynamic. But again, we built the business on a platform that is dynamic.
I love, in our industry, we tend to put a Band-Aid on things to fix the individual problem right away, right? That's our goal. Our goal is to get that borrower to the closing table as quickly as possible, Band-Aid it up so we can get that to accomplish. Where I think a lot of people fall apart is they don't go back and triage exactly what the problem was and how it doesn't become a problem again, right? And so I love the idea of throwing a process at it rather than people at it.
Well, you're saying, you're preaching to the choir on that. I annoy my people regularly when something goes sideways. I go, what was the up and the downstream impact on that? How is
Right,
it never going to happen again?
right,
Right? How are we going to document that? And then how are we going to make sure they adhere to it? Right?
right.
So we are 100% aligned on that.
Yeah, absolutely. Tell me a little bit about Pivot Financial. I love the breach services that you guys provide. Is that available for small shops, big shops, medium-sized
Absolutely.
shops? Like, give me a little bit about the core
Yeah.
structure,
So
what you're looking for.
so our clients run the gamut, everything from an independent mortgage broker, banker, all the way to some of the largest lenders on the street, right? We also have partnered with some of the aggregators as well, the investment banks, the aggregators, the hedge funds, et cetera. So we do not shy away or push away clients that need our help, right? I've been in the loan business a really long time, but even though I'm known for that, I'm probably better known for the asset management side of things, being
Right.
the co-head of asset management for Deutsche Bank, for example, hedge funds, REITs, and everything else, right? At the end of the day, what I am seeing happen in the repurchase world right now is not okay. You literally have counterparties deciding if lenders are going to live or die and making rescission or repurchase alternative decisions differently based on the size of the lender. And that's not okay. As a matter of fact, it's a breach of the lender contracts and the seller servicer guides, whether you're the GSEs, a non-agency aggregator, an FHA, it doesn't matter. So you absolutely need to understand what your contracts say. You absolutely need to understand what your rights are and what you are allowed or not allowed to do. The reality is there's a lot of, I hate to use the word shaking down going on, but there's a lot of, well, if you don't, repurchase this loan, even though it's not breach, we're just not going to buy your pipeline. And you know what? That's not okay. And quite frankly, in a court of law, you'd win, right? So
Yeah.
instead of doing that, partner with somebody with the expertise to very nicely, in concert with you and professionally, go back to whomever that counterparty is and say, this loan is not a breach, right? We've been a good partner to you. We consider you a good partner, and we're expecting you to be a good partner to us, because without these mutual synergies, neither one of us exists. And I
Right.
think if you can level set those conversations with people that really can have them with you, if you don't have those people internally, I think you're in a very different place than if you attempt to go at it alone.
So, new bumper sticker, lenders have rights too. That's what we're going to say.
Hashtag let the lenders live. How about
Yeah,
that?
exactly. All right. So before we wrap up, what's on your radar with regards to next level issues that might be coming back to our lenders? We talked about appraised values. And what else is on the radar? What are you starting to see bubble up a little bit, I guess is the question for you.
I think the ones that have been the most surprising to me is, the industry has generally been talking about the fact that, like 2022, 2023 loans have been coming back to them. Well, we're starting to see the rise of loans originated in 2019, 2020, et cetera, coming back as well. So I think, FYI, that's starting to occur, and we're probably going to see a lot more of that. So, heads up there. I think some of the other things, that the market really needs to have a voice about, away from breach of rep and warrant claims, are some of the things that you're seeing happen in industries that impact mortgage. A great example is the California insurance, homeowners insurance issues, and many underwriters not agreeing to issue homeowners policies and how much those premiums are going to go up. You know, you got to realize that everybody's aware California's got a problem. So I'd like to know how everybody's getting comfortable with their homeowners insurance right now on originating new loans when they know generally that the top 12 insurance companies are pending, you know, premium adjustments between, you know, 19 and 38% have been requested. And those are big numbers when you're thinking about the size of, you know, California homes. I think, you know, the new CFPB stuff that just came out with regard to the CFPB, you know, trying to dig into, I think what they're lovingly calling junk fees and other closing costs. I think, you know, I put up actually something on LinkedIn if anybody wants to go look at it yesterday. You know, they're not thinking about what it costs to actually manufacture the loan. They're talking about, you know, third-party costs, the cost of a credit report, the cost of an appraisal, everybody increasing their fees. Great. We got to remember, all regulators, there are humans, whether they're putting data into a, you know, AUS or they're manually underwriting. There are humans that it takes to originate loans as well. Lenders need to pay for them, okay? They have to pay to be able to do their jobs. They have to maintain their licenses. They have to go through their audits, et cetera. And all of those things cost money. Going after some of the aggregators that, you know, produce credit reports and whatnot, I'm kind of humored by it because GSEs are also going to now require another credit report with the Vantage score. So the CFPB is digging into how much they cost, but the GSE, which is the largest lender out there right now from an aggregator, is going to say, go get two. So I think we need to align, you know, what the interest and outstanding items are that the government generally is looking at and how that's going to impact the industry without taking into consideration what it costs to manufacture a loan. And I don't mean only pass through costs, right? I don't see how the industry can be robust. There's no way for it to happen.
Yeah. Some incredibly, I mean, 6 other podcasts just from that last conversation or that last segment right there, which is, you know, the cost of insurance is near and dear to my heart, right? I live out in California and we've talked about this. You know, what are people going to do about the condo associations that are going to, you know, they're losing their insurance policies? There's a lot of things on the radar. I appreciate your expertise, Jen. Thank you for taking the time. We'll put your contact information into the commentary down below for everybody to reach out if they ever want to connect with Jen. Jen, thank you very much for joining Non-Del Influencers podcast. Appreciate your time, and we'll have a great day. See you guys again soon.
Pleasure. Thanks, Matt. Have a great one. Bye.
Thank you.